Seth Klarman is one of the most underrated investors. His hedge fund, Baupost Group, has made an average annual return of 20% since it started in 1982 and manages around $25 billion. Many believe he's a younger Warren Buffett. In this video, we'll first explore his background story before diving into his strategy to uncover how he achieved incredible results so consistently through the decades. Seth Klarman has a book called Margin of Safety, which highlights his philosophy, and has been selling for thousands of dollars as only 5,000 copies were made. However, in this video, you'll get his investing advice without having to pay thousands. Part 1. Seth Klarman's incredible background story. As the founder of Baupost Group, he's built one of the most successful hedge funds in history. Seth Klarman's reputation comes from years of finding hidden opportunities where others saw nothing. Although what makes him very influential is not just his performance, but the wisdom behind his methods. Klarman's path into finance was shaped during his years attending Harvard Business School. There, he absorbed the teachings of Ben Graham, who was widely known as the leading pioneer behind value investing. He developed a strategy by blending Graham's principles with his own analytical thinking. Klarman excelled at Harvard Business School, as he was one of the top 5% of graduates. After graduation, opportunities came. William Porvu, one of his Harvard lecturers, asked him to invest the proceeds from selling a TV station. Soon after, along with several partners, they launched Baupost Group with $27 million in capital in 1982. During the early days of the fund, Klarman took a low salary, far less than others, as he knew he could make a lot more from performance bonuses later. From day one, his strategy stood out by highlighting the following principles. Firstly, protect capital first. Secondly, only buy when the price provides a margin of safety. And lastly, if nothing meets his requirements to invest, he would hold cash even if it's over 50% of the portfolio. Klarman dived into areas most investors ignored, such as distressed debt, real estate, and special situations. Similar to David Tepper, he likes to be flexible with his approach and use alternative investment strategies. Simply put, alternative investing typically refers to anything other than traditional investments like stocks, bonds, and cash. They can carry higher risk, complexity, and less liquidity compared to traditional options. However, alternative investments can yield higher returns and provide greater portfolio diversification, which is what Seth Klarman achieved. In the 1990s, his book Margin of Safety became an investing classic. But unlike many hedge fund stars, Klarman tried to avoid the spotlight and let his performance speak for itself. What makes Klarman's approach worth studying is its simplicity at the core and precision in execution. His framework revolves around a few powerful concepts: buying undervalued assets, insisting on a margin of safety, and waiting patiently for value to surface. Whether you're an experienced investor or just starting, understanding these ideas can transform how you view market opportunities. Part 2. Breaking down his strategy. During an interview with Goldman Sachs earlier this year, he mentioned something that fascinated the audience. He said, "The only way to invest well long-term is to be differentiated from the crowd. And the only way to die as a business is to be too differentiated from the crowd. And at the same time, the only way to outperform is to be different." It's a fascinating quote as it highlights the balancing act between standing out from the crowd while trying to beat the market. He focuses on bonds from financial companies that were trading at massive discounts. While others were worried, Klarman remained rational. He studied balance sheets, ran financial models, and searched for what he calls a margin of safety. Essentially, what he means by a margin of safety is the gap between what something is worth and the price. It's disciplined value investing, which is the philosophy he laid out in his now legendary 1991 book called Margin of Safety. Soon after the 2008 crisis, Klarman's bond positions had climbed around 25%. Most hedge funds took on major losses during the crisis, but Klarman's portfolio barely took a hit. At the center of Klarman's method is a single key principle: pay far less than something is worth, but we know that already. So, what makes his approach different, and how does he actually find an edge? Well, that's what we'll dive into next. His investment process has 5 key ingredients. Number 1, hunting for undervalued opportunities. He looks for assets other investors have ignored or punished too harshly. Number 2, he looks to buy in at deep discounts to create a margin of safety. Number 3, deep research. Every position is covered with deep analysis through financial data, understanding management quality, and industry analysis. Number 4, patience. He gives investments the time they need to grow instead of chasing quick wins. And lastly, he manages risk by not using leverage and diversifying across different asset classes in different countries and industries. Klarman doesn't compare himself to market indexes. If nothing meets his criteria, he won't force a trade. He's perfectly fine underperforming during market frenzies to protect capital for when real opportunities arise. Klarman has no concern in holding cash if no investment opportunities come. While many money managers fear being seen as doing nothing, Klarman sees cash as ammunition. It gives him the power to strike hard when the market panics. At times, Baupost Group has had over half its portfolio in cash. Baupost Group invests in many markets including public and privately traded debt, equities, bonds, real estate, and private equity. He embraces the complexity of alternative investments if it means others are overlooking value. But he never buys a bargain without a deep understanding of why the price is relatively low. If a price is low for no clear reason, he gets suspicious and digs deeper. His skepticism has saved him from countless bubbles. Deep value investing is about math and logic. Instead of chasing hype, Klarman hunts for steep discounts on intrinsic value by having a bottom-up approach first. Basically, a bottom-up first approach means his fund focuses on the individual merits of a specific company to seek investment opportunities, and after looking at broader economic or sector trends. When looking into the 13F portfolio, we can see it grew to $4.13 billion in Q2 of 2025. The total holdings were 20, with the top 5 positions shown here. Interestingly, the top 5 positions accounted for around 47%. As a result, the 13F portfolio is highly concentrated. However, it's important to realize that the rest of the hedge fund's assets under management are well diversified in the cash, real estate, debt, and hedged positions. Key elements behind his strategy include conducting in-depth research beyond surface metrics and making contrarian investments when sentiment is negative. He often targets distressed companies, turnaround stories, or industries suffering from temporary setbacks, situations most investors avoid. Klarman doesn't chase quick flips. He's perfectly comfortable holding an investment for years while the market catches up. Patience allows compounding to work quietly in the background. His discipline is equally crucial. When market euphoria tempts others, he stays rational and follows his research-driven principles. Focusing on long-term value helps him avoid the emotional traps that sink so many short-term investors. Picture this. It's a gray morning in 2008. The stock market is crashing. Lehman Brothers has collapsed. AIG is on the brink, and fear is everywhere. But while most investors are trying to get out of the market, Seth Klarman is doing the opposite. Months earlier, he had raised $4 billion from investors because he knew a crash would likely be coming soon, which would create valuable opportunities. As panic spread, he began deploying cash aggressively. Distressed bonds, mortgage-backed securities, and stocks were discounted significantly. One of his smartest moves was buying CIT Group bonds for around 65 cents on the dollar with a 15% yield. Most investors wanted nothing to do with it, but Klarman's analysis showed the bonds were deeply undervalued. When CIT restructured, the bonds climbed to about 80 cents on the dollar, which made a massive profit for him. Baupost Group also took advantage of forced selling in mortgage-backed securities. High-quality assets were being dumped at huge discounts, and Klarman was there to pick them up. If you're learning something new, feel free to click the like button. Thanks. Klarman relies on concrete metrics to spot undervalued opportunities. Some of his go-to tools include the following. Price-to-book ratio. A ratio below 1 can signal assets trading for less than their net worth. Price-to-earnings ratio. A low price-to-earnings ratio relative to industry peers can indicate hidden value. Free cash flow. Strong, consistent cash flow proves a company can sustain itself without constant borrowing. However, numbers alone aren't enough. Klarman places great weight on qualitative factors like strong and capable management, a durable business model, a competitive edge, whether through patents, brand power, or unique positioning. And lastly, sound governance and transparency. Combining complex data with sound judgment gives him an advantage that pure quant investors often miss. A classic example of his strategy in action was Baupost's investment in General Motors when sentiment around the auto industry was grim. Back then, GM stock was trading below its book value, yet it still had solid cash flow and a manageable debt load. Klarman recognized the turnaround potential under a new management team and bought in when others were running away. As GM stabilized and restructured, the market slowly acknowledged its true value, and the stock soared. Klarman's patience and contrarian stance ended up paying off greatly. Despite being known for taking on alternative investments and making concentrated bets, Klarman is not reckless. He manages risk meticulously by analyzing financial stability, stress testing scenarios, and maintaining a diversified mix across industries, regions, and asset classes. For example, he might balance distressed equities with bonds or real estate, ensuring the overall portfolio remains resilient even if one bet takes longer to play out. Klarman's process starts with finding value hidden in chaos. When markets overreact and great businesses get punished alongside weak ones, he's watching closely. He zeroes in on companies with strong long-term earning power, but may have been temporarily pushed down by fear rather than fundamentals. Next, we'll look at why cash is one of Klarman's most powerful weapons. To Klarman, cash isn't wasted capital. Unsurprisingly, it's a strategic weapon of his. When markets are soaring and good deals are scarce, he has no problem sitting on cash. That restraint protects him from overpaying when prices are inflated. It also gives him the flexibility to pounce when bargains emerge. Don't rush to deploy every dollar. A healthy cash cushion can mean the difference between chasing overpriced assets and buying when it truly counts. Cash on the sidelines isn't enough. Timing matters. When markets fall apart, he doesn't hesitate. Seth Klarman's strategy may sound simple, but executing it takes discipline most people don't have. Here's how you can apply his philosophy. Look for real value. Don't chase hype. Dig into fundamentals and find assets trading below their true worth. Protect your downside. Always insist on a margin of safety before investing. Be patient. Great opportunities don't appear every day. Holding cash is not a weakness. It's preparation. Think long-term. Ignore short-term noise and focus on the intrinsic value of the business. Stay contrarian. When fear grips the market, calmly look for bargains others are missing. Klarman once said, "The single greatest edge an investor can have is a long-term orientation." In a world of short attention spans and quick trades, that edge has become rarer and more powerful than ever. Klarman isn't a celebrity investor chasing headlines. He's known for avoiding media attention, focusing on research, and quietly compounding capital for decades. His book, Margin of Safety, remains one of the most sought-after books in value investing, and his influence extends beyond Wall Street, with countless hedge fund managers and retail investors studying his letters and philosophy to this day. Today, Seth Klarman remains the CEO and portfolio manager of Baupost Group, where he has proven that investing success doesn't come from predicting the future. It comes from preparing for it. His hedge fund manages around $25 billion. By focusing on value, patience, and risk control, he's built a legacy that every serious investor can learn from. His playbook isn't about beating the market every quarter. It's about winning over decades. Over the decades, Seth Klarman quietly became one of the greatest investors of all time. Feel free to check out more interesting stories here. If you enjoyed the video, consider clicking the like button and subscribing because you won't want to miss out on my upcoming videos. Thanks.